here to talk about the state of the economy with the Principal Economic Advisor, Mr. Sanjeev Sanyal. Many thanks for taking your time out and speaking to us at ET Now. Should I say I'm talking to the next Chief Economic Advisor? Many say you're the front runner.
Clearly not something I can comment about.
Okay, let me start by talking about, the RBI commentary. Recently, they've gone ahead with 2 rate hikes consecutively in a span of 4 months. They've even gone ahead, hiked their inflation target, and they are attributing it to the MSP hike, while it is yet to play out. How crude prices are panning out. They're also calling it the vulnerable and volatile crude. Given how things are shaping up globally, the macro headwinds that we have, and even domestic headwinds as well, how do you really see it? Do you see RBI getting more hawkish in the year to come, given the fact that this is going to be an election year?
I mean, the RBI quite responsibly lays out various risks to its worldview. But let's be clear about what it's forecasting. The RBI's forecast is very clear. It expects GDP for the second half of the year and going into the first quarter of next year to be in the 7.3 to 7.5%. This makes India the fastest growing economy of any significance in the world. It also says that the risks are evenly balanced on either side. So this is not something with a unidimensional downside risks. It also says that inflation, which is right now running at about 5% for the consumer price index, is likely to moderate marginally to about 4.8% or thereabouts for the rest of the year and into the beginning of the next financial year. So basically what you have is a picture of very robust growth, inflation well within the RBI's target band.
But we are inching closer to the 5 to 6% band as well.
No, not really. Their forecast is 4.8, so it's closer to the midpoint. In any case, the band is a fairly broad one, so it's well within the top range of the band of 6%. And again, in the case of inflation as well, it says that risks are even on both sides. So what we have here is growth that is very robust, macro risks evenly balanced, and basically an economy that's growing very well despite the fact that we are not doing anything to pump demand in any way. Fiscal prudence means that our fiscal deficit is well in control. The monetary policy has again been tightened and has, in fact, if anything, been reasonably tight throughout. You have a banking sector that is not going out and lending very aggressively. So, this is not a demand pumped economy, and still growing at a real rate of 7.5% or thereabouts.
I understand, when you're saying that this is not a demand pumped economy, and let me, play the devil's advocate here. I understand that, we have begun to see little signs of revival when it comes to private investment. The RBI's capacity utilization survey says that we are at about 75.2%, which is, a 2-year high when it comes to private investments. But are you seeing secular growth? Because what I am given to understand is that sectors like real estate, sectors like consumer durables, they are still going to take a little while before we actually see a turnaround. And most of the companies that you see, we are seeing probably an earnings turnaround. Only because so far they're massively looking at cutting their costs. There are no new jobs that are being created. There is very little in terms of what the companies themselves are saying in terms of how they are seeing an outlook from a 1-year perspective from here.
Well, there were huge capacity creation excesses that happened, as you will remember, at the beginning of this decade. But those were unwound over time, and as you yourself have pointed out, much of this excess has now been wound out in multiple ways. So on one end, you have the capacities being used up, and in fact that number you gave is the average. There are many sectors where in fact we are facing capacity constraints, particularly in some of the areas related to capital goods. So again, tells you that investment is coming back. Meanwhile, what we are doing is cleaning up the banks as well. Remember, many of these excesses were lying in the banking sector, and thanks to the insolvency and bankruptcy process and also the recognition of many of these as NPAs, much of the books of the banks are now open. We know where the stresses were, they have been accounted for, provisioned for, and so in some ways we have a banking system which clearly knows what it has on its books and is, as you can see through the IBC process, you are seeing the NCLT one by one taking out the bigger cases. So as a result of which, there is genuine momentum in this economy. So this is not, some statistical fact pumped at all.
But where are the greenfield projects? Because barring the Samsung that has come out with a new plant in Noida, there is very little real activity that's happening on ground. A lot of people are questioning where are the jobs. I mean, this is something that we've been discussing for some time, and in fact Union Minister Nitin Gadkari himself saying that at a time when we are talking about reservations, one has to look at the broader picture, the broader issue of whether jobs are being created.
So of course, in a country our size and given our demographics, jobs is always an issue. But this argument that is often thrown about without any data that no jobs are being created is absolutely not true. To the extent we have data, it suggests that job growth is indeed happening, and in many sectors, in fact, there is happening. For example, there's massive growth. I'll give you an example. Civil aviation. Just in the last 15 months, we've opened out 29 new airports, and as a result of which, civil aviation has dramatically expanded out. And just one example. You've also had massive growth in sales of cars. You're seeing good sales and consumer vehicle sales. All of this, I mean, somebody is driving those consumer vehicles.
But Mr. Sanyal, on the other hand, there are sectors like telecom where we are seeing massive consolidation taking place. A tariff war that is playing out that could also lead to massive job cuts. I mean, isn't this the big worry of this government?
So you're contradicting yourself. Why is this consolidation and sort of corporate war in that sector going on? Because a very large player is going out and laying out cables, setting up capacities. Even that is creating. So yes, the competitor to Reliance are facing the pressure, but as a sector it is expanding massively. So do not confuse the problems of incumbents when a new player comes in. For the economy as a whole, as long as there is no anti-competitive behavior, which is of course the Competition Commission's problem, as an economy as a whole, the telecom sector is seeing massive rollouts of capacities. In fact, we know that the average Indian user of telecommunications uses now more data than any other in the world. I don't know if you were aware of this.
No, absolutely.
So obviously somebody is creating jobs in those sectors, and you have many others, by the way. Let's take tourism, for example. Oyo is one of the biggest holders of hotel rooms in the world. It didn't even exist maybe 5-6 years ago. So there are many sectors. There are huge expansions that are going on, and Oyo is a completely greenfield project in that sense.
Yeah, but on the other hand, the flip side is with technology being such a huge disruptor, this is going to take away some jobs as well. With artificial intelligence also coming in.
So, well, in the services sector, less so, but yes, artificial intelligence is an issue not just to us, it's a global issue. The good news is that as we industrialize into this new environment. So, in some ways, this is a good thing, because it means that the capacities that we create, which are mostly going to be in the future, will be created in an environment where we are already bringing in technologies and we are leapfrogging into that space. We, in fact, do not have the problem many other countries will have of having legacy capacities, legacy human capital. So, while yes, it's a problem, technological changes causes disruptions everywhere in the world, but is it a special problem to us? Well, probably not, given that we do not have a legacy problem, and because we are moving into completely new sectors where we didn't have capacities before.
Since we are talking in an election year, about 10 months from now, we will see the government getting into elections. In terms of jobs, what is it that we should look at? I mean, what will be the jobs of 2019? What will they really look like?
So I think it's, we do not think about it like we have to create jobs in the next 10 months kind of approach. That is entirely not a healthy way of thinking about it. In fact, we don't like to do this kind of demand pumped approach to this. What we have to do is create new sectors, expand them out, and create sustainable jobs for the next generation that we need to keep employing. So as I pointed out to you.
So have we been able to identify these new sectors?
So first of all, we don't live in the world of licensing, so the government does not go around necessarily identifying a sector, but yes, there may be some specific sectors where we may provide some support or even infant industry protection, but generally speaking, what we want to do is to create ease of doing business. So this means, for example, creating the frameworks of governance. What are these frameworks of governance? Well, one framework of governance is the Insolvency and Bankruptcy Code, because if you want to create an economy based on risk taking, then you obviously need a system of liquefying things that go wrong along the way. So that is a massive new framework that came into place just, the law came in 2 years ago. In the last 15 months or so, we have operationalized it. That's a very major area. Another one is GST, another major framework of governance. We were not, as a country, a unified market. Now we are. Did that thing work right up front? No, there were all kinds of problems in the beginning. We fixed it along the way. A year later, we genuinely have a unified market. The GST system works reasonably well. So all of these things are things that create opportunities. So to say that in the next 10 months we have to create all these jobs, no, these are frameworks that will pay us for generations. I mean, 50 years from now, people will still talk about when we introduce the Insolvency and Bankruptcy Code. So this is like long-term thinking.
All right, point taken. I will talk about GST and IBC, as we go along, but let me talk about the banking sector. You've been looking at the banking sector very closely. You even came up with the whole host of changes that we have seen now happening in the Insolvency and Bankruptcy Code as well. And as we're talking about, the capex revival, private sector really getting their act together, in fact, moving ahead, the funding needs will also arise. Given the fact that, we have 11 banks that are under the prompt corrective action, a lot of this heavy lifting will have to be done by private sector banks. Is the banking system really, moving ahead, and are they really adept at handling the kind of funding needs that we will see in the times to come?
This is certainly a very issue that we think about quite a lot. Clearly, we have a banking system which was stressed, and we opened out their books, we forced recognition. There were several scams as well, which, as you will be well aware, that also came popping out as we opened out and went through all the paperwork. And now what we do is we know what the state of the banks are. Now the point is we need to get it going again. For that, certain amount of recapitalization is being done. Also, the good news that some money is coming back from the IBC process. As you may know, the first 12 cases alone, my guess is somewhere in the range of maybe 1.2 lakh worth, lakh crores worth will come back just from the first 12 cases. But even outside that, there are many large numbers of cases where the companies have come back and repaid loans even before they got into that process. And I'm told it's something in the number of 80 to 90,000 crores worth that came back even before they went through the process. So very sizable amounts of money that have coming back from assets that were provisioned for, written down, are coming back. So that's another source of resources for banks. But point taken, there will be areas where the government may have to provide them support, and wherever it is necessary, we will provide it. Particularly since we recognize that while the very large companies can fund themselves through the capital markets or even go abroad, it is the MSME sector that relies heavily in the traditional banking system.
Which is exactly why I asked you this question, because today a parliamentary panel has on commerce has come out with a report, and they're saying that it is the MSMEs are suffering because of the fact that PSU banks are not being able to give them the required support. They're asking for too much collateral. They're asking for there is very high cost of credit, and this is leading to contagion conservatism in PSU banks. Do you agree with that statement?
Certainly, if capital requirements of particularly working capital requirements, but also expansion capital requirements of our MSME are not getting funded by the banking system, particularly the public sector banking system, it is something that we will take very seriously. And that is particularly a concern when obviously several of these banks are under the PCA framework, where obviously there's a natural constraint to their growth. So it is a matter that we take very, very seriously. Obviously, there are some ways to bypass it. There is the Mudra scheme. NBFCs are providing some capital. So it's not like there's no capital, but it is a matter that we take very seriously, yes.
So what kind of changes can we look at in the times to come, especially for MSMEs? I know there is a council, the GST Council has put in place a group of ministers that they will be looking at all the MSME related issues. But what is it that the government can do? And when you're saying that, we will be addressing the funding concerns, then how?
So obviously, some of the public sector banks are in relatively healthy things, and so wherever they require capital requirements, we will encourage them and support them to grow. The private sector banks, of course, are already growing quite well, and of course, we need to at some point begin to think about what happens to the PCA banks at the other end of the process as they come out of it. So there are a host of issues that particularly the Secretary DFS may be better able to tell you the micro measures, but this is an issue that the Finance Ministry takes very seriously, and we understand that without getting the public sector banking system lending again, our MSME sector cannot get going. So this is something we think about a lot, and measures will be in the pipeline.
How soon can we expect the, I know out of the 2.11 lakh crore rupees that was promised to the PSU banks, a lot of it has already been disbursed. When do we see that last tranche, the final?
So it will be done, as I said.
Is there going to be a criteria for it?
Well, some part of it has to be regulatory capital, because that's regulatory. Right. But we do recognize that we need to give growth capital to particularly the better banks. So where necessary, growth capital will be provided, yes.
Okay. Let me also talk about the Insolvency and Bankruptcy Code. Do you believe, like many people are saying, we are behind the timeline when it comes to the resolution in those 12 cases, because a lot of it is still stuck in litigation, barring Bhushan Steel or a couple of other cases. We are seeing very little activity, and perhaps when it comes to recovery, only about 1 lakh crore rupees out of probably 2.5 to 3 lakh crore rupees that initially was the amount of NPAs in these 12 cases. In that case, does this make the government little uncomfortable? Is it a cause of worry? Because the recovery here is very little, and the banks have taken huge haircuts even in these 12 cases, and this trend is going to follow across the board.
So in these particular cases, look, this is the NCLT literally going through its first round of this process. So it is taking some time, because new processes are being created, new precedents are being created, and so on. So we are, as we go through this, remember creating literally the precedents, processes, rules, regulations, and you may see ordinances being we keep coming out with. Now we have got a whole bunch of new processes for what happens to the smaller cases up to 50 crores, 50 to 500 crores, and so on. So that was another thing so we are putting in place the ecosystem of it. But I think you're being too conservative about how fast these first 12 cases will get done. I think we saw in the last few weeks several large cases getting done. There were the courts went on a brief break. They are now back in action, and in the next few weeks you will see some more big cases getting done.
All right, that's a very positive note. Let me also talk about another big issue that the Finance Ministry is dealing with, and that is the NPAs that we are seeing in the power sector. Last time when I spoke to you, you said that the differentiated norms for power sector are looking tough, and now there is a report that the DFS Secretary has proposed, in which he is saying that another 180 days should be given when it comes to commissioned projects. Isn't that a differentiated approach?
Clearly, we adjust along the way, and I think I always say that, look, we try to do our best, but when we get feedback that you need to change, we will change. So I can only say that the DFS Secretary did go through this issue, and we will look at this proposal and take a call. In general, having too many differentiated approaches for every sector is too confusing and complicated. So it's not something we like to do usually. Now, in the specific case, for example, real estate, you may have to do it because there is a specific problem, because home buyers are a part of the ecosystem, which is not the case in other sectors. Now, in the case of power, maybe it does need it, maybe it doesn't, but I will I would say that I will have a look at that particular report before I make up, and others in the system will also have a look at it, and we may decide to take that path.
But is it a good practice? I understand there are several other core sectors that are in some sort of a trouble and they need probably a helping hand. Is this going to be the approach for them?
In general, no. But supposing, I have to go through that particular report, but it might be decided that the power sector is a specific sector that at this point in time requires special help, then so be it.
Before I wrap up, what we're discussing on the banking sector, I also need your comment on the LIC IDBI deal. We are in the final stages when it comes to the clearance of the IDBI LIC deal, and experts have raised a lot of questions on the interconnectedness of LIC. Everybody is saying how LIC has become too big to fail. The fact is that LIC is buying government bonds. They are involved in, they have over 10% stake in about 6 PSU banks, and apart from that, LIC is also participating in in the government's divestment drive as well. Why couldn't we come up with a more commercial decision when it came to LIC picking up a stake in any bank? Why IDBI Bank, which was perhaps one of the worst performing banks?
Well, first of all, don't assume it's not a commercial decision. LIC is a huge, it's by some margin the largest financial institution in the country. So it's not that surprising that it is the largest buyer of government bonds. It's also a major player in, for example, picking up stakes in various corporate, including public sector corporate entities. So yes, it is a big body, and that's a different debate about whether or not it's too big or not. But that's not, I think, the main issue that is usually raised. The main issue that is raised is this IDBI deal some sort of a clandestine way of not privatizing, and I think that is not fair. I think it is a commercial decision. It was LIC has in the past taken similar commercial decisions vis-a-vis government-owned entities,
but this is
has made a good profit out of it.
I take your point on that, but this is not opportunity buying, opportunity selling.
No, so the point of the matter is, you say that it is the worst performing bank. First, that's a value judgment, but other than that, remember, it's all about the price. It's not about.
1/4 of the books of the bank has NPAs, like almost.
Question is at what price you're buying it. And now, supposing it was a perfectly fantastic bank with no problem at all, would they get it at this price? Possibly not. So the point is that a commercial decision had to be made, and don't judge whether this is a bad commercial decision. That only time will tell. But for now, you have to go with what the board of LIC and board of IDBI have decided, and who knows, maybe it will turn out to be a fantastic decision.
Okay, we hope that it does. Will we hear more on mergers and consolidation in the banking sector, given the fact in the next 10 months we will see elections coming?
I don't quite know why this comes up all the time. I can't see how consolidation of banks has anything to do at all with elections. The fact of the matter, and that's a point I've made before, is that this is a second order solution. The first order solution is to get the banks running again, to capitalize them, the ones that are outside PCA to grow again, and even the ones that are in PCA to get them off PCA in the longer run, and get the capital requirements for investment and working capital for the economy in general and the MSMEs provided for. That is the key thing that we need to do, and of course cleaning up the NPAs through the IBC process. Longer term, we will need perhaps to consolidate and rationalize, but those will be done with commercial decisions. There's no point in taking two poorly performing banks and adding them together. All you get is a larger, poorly performing entity. So the only reason you would want to do this is for purely commercial reasons. If two banks coming together allows, branch consolidation, or it allows some sort of rationalization or specialization in a specific sector or region, there's some commercial reason to do it, then it makes sense. Otherwise, simply adding or subtracting banks without looking at the wider commercial aspects of it is simply pointless. So we recognize that, and that is why we haven't peddled that as being sort of the front line of things we do. It's a second order thing that we need to look at, but for now, let's get these banks running up and again, and let's make sure this NCLT process and other Samadhan and other schemes that we have put in place for resolving the NPA problem gets done, and most importantly that the financial system provides for capital requirements for an economy that is clearly gathering steam. Clearly investment is coming back very strongly. We need to be able to provide it capital.
Mr. Sanyal, I take all your points when we're talking about the banking system, but let me talk about the other big issue, the global worries that are obviously there. And as growth momentum is picking up, how big are the worries on crude? How big are the worries on the way our fiscal deficit is panning out, our current account deficit is panning out? Because many people are saying that perhaps we're seeing those worries on the twin deficits coming in again, given how trade deficit was at a 5-year high.
So the twin deficit has a lot to do with the internal part of it is in fact improving, because our fiscal is in reasonable shape, our corporate balance sheets are in reasonable shape. So one part of the twin is well improving. Now the other side of the external sector, however, there is obviously a concern over crude. I mean, we are an oil importing country. If oil prices remain elevated, it's bad for us. I mean, we can juggle around with it internally, but frankly, it's not a happy situation if oil prices are high. So it is something we watch. They have recently come off a little bit, but still at elevated levels, but certainly something that is, especially with US sanctions on Iran looming, a matter that obviously is of some concern to us.
Here there was a long-term policy that we were looking at for crude prices. Has that been put in abeyance, because we haven't heard from the government on that?
The fact of the matter is, in the end, international prices is what matters. You can do whatever you want internally. That is really in which pocket you want to take the hit. Oil prices being high is a concern. In the very long run, the only solution is that we reduce our dependence on foreign oil. But short of that, there is nothing much you can do as such as far as that is concerned. Similarly, the other big concern obviously is trade wars and the concerns around that, and RBI highlighted that as well. Again, it's a matter in which we are watching an evolving situation. We are not the primary mover of any of those changes. And I think many times our officials have made the case that we need to push for a multilateral WTO-based system. But nevertheless, as with every new situation, each problem will throw up new opportunities as well. So let's watch how this goes. My own guess is, rather than having a preconceived notion about where this whole thing is headed, the key thing is that we as a country and as an economy, both the government and the corporate sector need to watch this carefully and respond quickly as the situation evolves. So while there will be problems, I am 100% sure that new opportunities will emerge out of this.
Because you're talking about trade wars, let me also talk about the other issue which the RBI highlighted, and they said the way things are panning out, we could very well see a currency war. Is 68, 69 a new normal for the Indian rupee in that sense?
Our exchange rate has for a very long and very well-established way of being managed by the Reserve Bank, which is that the rupee in the medium term to long term find its own level, but in the short run, foreign exchange reserves and other measures are used to control high volatility. So that remains to be the case. And those of you who have suffered through studying economics in university will remember something called the impossible trinity, which is that if you have open capital accounts, and we have more or less open capital accounts, there's some capital controls, but it's more or less open, then basically you can either control the monetary policy or you can control the exchange rate.
Absolutely.
And because we created a monetary policy committee and therefore we opted for managing our monetary policy, so we will have to essentially in the medium term take the exchange rate as it comes, determined by the market. But of course, as far as spikes in either direction is concerned, the Reserve Bank has more than adequate resources with 400 billion plus in reserves to manage spikes in either direction. But I think beyond that, we have for now quite some time, almost a generation, allowed the market to determine where the exchange rate goes.
All right, on that note, many thanks for taking your time out and speaking to us at TT Now.
Thank you.